What happens if I get a margin call in ICE futures? Have you ever wondered what it means to get a margin call while trading on ICE futures? Let's break it down in simple terms. When you trade futures contracts on the Intercontinental Exchange, you are participating in a financial system designed to manage risk. This system is a key part of capitalism, where individuals and businesses engage in trading while following specific rules. First, let's talk about margin basics. When you open a futures position, you need to deposit an initial margin. This is not a down payment, it acts as a performance bond. The amount you need to deposit depends on the specific contract, its price, and how volatile the market is. Your broker may require more than the minimum set by the exchange. There's also a maintenance margin, which is the minimum amount you must keep in your account to maintain your position. Now, what happens if the market moves against you? If your account value drops below the maintenance margin, you will receive a margin call. This means you need to deposit more funds to bring your account back up to the initial margin level. It's important to act quickly, as this is not optional. If you do not meet the margin call, your broker can automatically close your position to prevent further losses. Let's consider a practical example. Imagine you buy a canola futures contract and deposit the initial margin. If the price of canola falls, your account value decreases. If it drops below the maintenance margin, you will get a call to add more funds. Failing to do so could lead to your position being liquidated. This process helps keep losses from spiraling out of control and maintains market stability. Why does this system exist? In capitalist markets, margin requirements and calls are essential for maintaining market integrity. They allow traders to take on leveraged positions, which can amplify both gains and losses. This system reduces the risk of default, which could destabilize the market and affect other participants. It encourages responsible risk management and aligns with the principles of individual accountability. For certain products, like future-style options, variation margin is called daily. This means gains and losses are settled in real time, reflecting daily price changes. Additionally, during periods of high volatility, you might face intraday margin calls. If your exposure exceeds set limits during the trading day, you may need to post additional margin immediately. If you cannot meet a margin call, your broker will close your position. This could result in a loss, and you will still be responsible for any deficit in your account. The process is quick to prevent losses from exceeding your deposited margin. In the world of derivatives markets, margin calls are a practical tool for managing the risks associated with leverage. They help ensure efficient price discovery and liquidity. While you have the freedom to trade on ICE futures, you also bear the responsibility for your positions. The market provides a framework for managing risk, but the outcome depends on your decisions and market movements. To sum it up, margin calls are triggered when your account falls below the maintenance margin. You must deposit additional funds quickly to avoid having your position closed. If you fail to meet a margin call, your position will be automatically liquidated. Understanding margin calls is essential for anyone trading on ICE futures, as they play a vital role in how modern financial markets operate.